Welcome to DROX Investment Group Show, your source for apartment investment, operational strategies, and market analysis. Your host is Nguyen Do, CEO and co-founder at DROX Investment Group, a Houston, Texas-based multifamily operator who has purchased and invested over thousands of apartment units and managed over $280 million in assets. Join us as Nguyen Do interview experts from all over the country as they share their wisdom and inspire you to grow, invest, and to impact. Here is Nguyen Do.
This is the beginning of the new year, and you're just looking at your W-2, and you just made $500,000. You're just so excited. But then you look at, the federal income tax statement that you just have paid over $144,000 in federal taxes to the government. That money, my friend, you can never get it back. And as a taxpayer, you say, why should I even work more to pay more money on taxes? So what should I do? This is Nguyen Do from DROX Investment Group. And today, we're going to show you how to leverage on those tax codes. As a high income earner, we want you to reduce your taxes and put more money in your pockets. So you can do whatever you want, invest more or go give to charity more. But that's our goal. So today we have a very special guest. He has earned his bachelor degree in accounting information, as well as a master business administration in accounting, focus in accounting from University of St. Thomas. He has over 18 years of experience in diverse tax, accounting, and business consultant experience. He has helped numerous of his clients saving thousands and thousands of money on his taxes. And Henry, not only that, he has worked in accounting and a management role for a variety of company and CPA firm. He also a licensed as a certified public accountant in Texas. So everyone, thank you so much, Henry, for joining us today.
Thank you for having me.
How are you doing today, Henry?
Doing good, doing good.
Yes.
The new year.
Yes, at every year, right? Everyone, when we looking at our W-2, we were so happy. We were so proud that we make so much money. But then when you see how much taxes you have to pay, and that's when you say, oh my goodness, what can I do in order to save some, put more money in my pocket? So this is the beginning of the year. And thank you for being here and to share with us, some of your 18 years of experience you have helping with all your clients, your business, a small business owner, how to save their tax. Yeah. So
you're right. It is the beginning of the year, and a lot of people are getting these tax forms, and they're seeing how much they made and see how much has been withheld, and I guess we can kind of touch base on some important tax dates that are coming up first, and so that people know what what's coming up. So if you're a business owner, 1099s and payroll reports are due on the 31st of January. And then the next big thing is if you are a business owner and you have a business tax return that's either an S corp or partnership, that's due coming up on March 15th. And then personal returns, C corps, trust returns, and first quarter estimated tax payments for 2023 is due April 15th. Technically it's April 15th, but I believe this year is April 18th is the actual filing deadline. So so personal returns, C corps, trust returns, and first quarter 2023 estimated tax payments is due April 18th this year. And then the last one for business owners that if you're an LLC in the state of Texas, you have a franchise tax return obligation, and that's due May 15th of this year. So those are kind of major important dates that are coming up that, as a business owner, you want to kind of keep that in the back of your mind as the months come along. So
yeah, thanks for that. Right, because you do not want to be mess with Uncle Sam.
Yeah, you don't want to wait till the last minute and be like, oh my gosh, I need to file this return or that return, and sometimes I get clients that call me up, say, I opened up a new business this year, I need to file an extension for this LLC, and it's after the deadline. So we try to avoid that as much as possible.
Great, great. Thanks for those dates. And everyone, that is the most important dates, okay? If something, don't ever forget those dates. And don't worry, we're going to put those dates actually in the bottom in the comments below. So at least you can have some of those emerging dates. So Henry, you know, as we all are, there are a lot of low hanging fruit from a tax perspective that we can just, many of us can actually apply. And we don't, before we get into the advanced tax strategy that can save, you know, many of us that maybe majority of us regular people would not know. How about you go over to those low hanging fruit that, you know, many of us can make sure that we actually check the box for those.
Sure. Yeah. So the main thing is the standard deductions that the IRS gives you every year. For 2022 tax year, it's going to be $12,950 for single filers, and for joint filers, it's $25,900. So the IRS is nice; they automatically give you that. But sometimes you can itemize if you have itemized deductions that are higher than those limits, the standard deduction limits that I just mentioned. Things like if you add up your real estate taxes that you paid, still capped at $10,000 per year, any mortgage interest that you paid, and then charitable donations, like you mentioned earlier. So if you add those three items, those are the three main bucket list items that are in the itemized deductions. Other things is medical expenses, but there's limitations on that as well. But you know, if you have medical expense, a big medical expense in 2022, you can go ahead and add, you know, put that into the bucket as well.
What about the HSA? Can you put those money in there as well?
HSA is a separate line item.
Okay.
Yeah, we'll touch base on that in a second. But HSA is outside of the itemized deduction list.
Okay.
And so you add those three main things up: the real estate, the mortgage, and the charitable donations. If it's higher than the standard deduction limits that I mentioned, the $12,950 for single or $25,900 for married filing joint, you know, it might be worth it to gather those items and give it to your CPA and be able to, you know, take a deduction on that. So you don't want to lose those deductions. So those are kind of the basic, you know, deductions for, you know, especially W-2 employees.
I see. Okay, so property tax, medical expenses, and basically interest rate if you have a mortgage, right?
Yep, if you have mortgage.
If you have mortgage, and maybe sometime if you're buying new cars, right? Those are the sales taxes, things like that. That makes you, So you have to
sales
compare.
Tax is included in the real estate as well, in the real estate tax bucket. So which is capped at 10,000 still, unfortunately.
But Henry, what if a person that, you know, when they look at the itemized and their standard deductions, like right at the par, like, you know, just a couple $100 different, what do you suggest them to do?
So I suggest if you're one of those people that your itemized deduction is very close to your standard every year, one of those things you want to look into is, you know, should I go ahead and just give more to charity, right? And see if that's going to benefit you. You know, that's the main thing that can always be changed, you know, and obviously you have to do that before the year ends over. So I get a lot of calls in December asking about what the standard deduction is, right, for the year. And then I always look at their previous year and I said, okay, well, based on last year, this is how much you have as itemized. And then, you know, they'll tell me, oh yeah, I bought a car this year, or I plan on giving, you know, X amount more to charity before the end of the year. So how much more can I give, you know, and how to benefit? So that's, you know, a lot of people give because they want to give, but then a lot of people want to do, you know, give also because they want, you know, to give and also get a tax deduction and make it worth the giving.
Yeah, so thanks for that. So those
are
the low hanging fruit.
Yeah. Go ahead.
I say those are the low hanging fruit. Everyone should be looking at those categories and buckets for when you're doing your tax. So let's just say, so now those are the low hanging fruit. We look into it and then now we take itemized deduction or, you know, based on the standard. So what else can we put more money into our pockets, Henry, so that, you know, we don't want to, we're a good patriot citizenship, but we always want to find legal, strategic ways in order for us to put more money in our pocket. So help us out here, because we all want to listen to this. We want to know.
Sure, yeah. So one of the things you mentioned earlier was HSA. So if you have a HSA qualifying medical plan, you can put money away into HSA every year, and it will be a tax deduction, or it will reduce, if you do it through your W-2, your company, it actually reduces the taxable income on
Yes.
box one that shows up. So you'll be paying less taxes on it. And then if you do it outside, it actually is a tax deduction. It reduces your earned income, you know, and then, you know, before it calculates the taxable income.
Right.
And so, you know, again, some of these, a lot of higher income earners like to do that, and not necessarily because they can put money away, but what they do is after you turn 65, you can pull it out without having a penalty. So how HSA works, for those who don't know, is you put money away, you get a tax deduction. And if you have a medical expense throughout the year, you pull from the HSA and you say, hey, you know, I need, you know, $2,000 to pay for this procedure, or to reimburse me for this procedure that I had to pay for. And so those are what they call medical, qualified medical disbursements. And we report that on your return, and we state that all those were, all the disbursements were medical related, and there's no tax consequence at all.
Oh, that's
But if,
good.
right, but if you don't have a medical expense, if you pull it out and it's not medical related, they're called unqualified distributions. And if you're before the age, if you are, you know, before you turn 65, what happens is there's a 20% penalty for that withdrawal. And then you also have to pay taxes, you know, whatever your, it's added to your taxes on there. But one of the things that higher income people use HSA for is they keep it in there. If they need it, they use it. But if not, after the age of 65, there's no more 20% penalty. So you could take it out without having to pay the 20% penalty. You just have to pay taxes on, you know, the distributions. It's kind of similar to like a 401k. You put money away in a 401k, and you pull it out early, there's a 10% penalty on that. And but yeah, this is just an extension of the 401k for W-2 employees.
Is there limits on HS amount per year that you can contribute?
Yes, I believe, I don't know the exact limit on HSA, but it's around 6,500 or 7,000. And it's family or individual. So I think it's like 30, if I remember, it's like 3,900 for single. And then for family, I think it's like 7,800, somewhere around there. But yeah, they change, go up a couple hundred every year. So.
Oh, that's good to know.
Yeah.
Back pockets, you save, reduce on your gross income, right?
Yes,
so from that,
absolutely.
And I'm sure everyone have some type of medical. Is dental included as an HSA? Can you? Okay, see, we all have dental work.
We all do. We all have, you know, all
especially when we have
types.
kids.
Absolutely.
Okay. Good. Thanks for sharing the HSA. What other strategy, Henry, that you can always share with us?
So again, you know, 401k, you know, is another thing that you don't want to miss out on, especially if you work for someone that gives you a 3% match. I think that's, you know, a great way to put money away and let it grow, and you know, take money out when you need it. You know, it's a savings strategy, right? So and also, like I said, it reduces your taxable income on your W-2. And another type of retirement plan is a SEP IRA, and those are mainly for business owners.
Right.
Who have their own business. They could put money away into a SEP IRA, or you can even do a solo 401k. It just depends on, you know, income level and how much you want to put away, things like that. There's limits on everything. SEP IRA is 25% of your earned income.
Right.
And then solo 401k, I believe it's the same limits as 401k is, which is like 20 something thousand. You know, and then if you're over the age of I think 55 or something like that, there's a catch up. So,
right.
Yeah.
Yes.
So yeah,
like,
that's.
You're right, because if your company is matching you with any percentage, make sure you maximize that out, because that's basically a dollar you put in is basically it's 2 times, right? So a dollar you put in, you actually get $2 immediately, you know, losing or not. So always maximize that matching program that you have from your company. Yep.
Yeah. So, yeah, and then this is, you know, the next few things I'm talking about. Well, let's talk about another one that we're just talking about W-2 employees. Solar panels, you know, like home improvement type things. So in 2022, they went back and it used to be in 2020, it was 30% tax savings on the cost of the entire system. And then 2021, I believe it went down to 26%.
Okay.
But then with the new tax law that came out, they actually went back up to 30%.
That's
So,
nice.
you know, if you end up thinking about getting solar panels and, you could save 30% on the cost of the system, and you can even obviously save, electricity, if you have, you could probably save $10,000 to $30,000 in the lifetime of the solar
Yes.
panels, and
And I know you
can get
installed solar
creative.
panel in your house.
I did. I got solar panels with the batteries. So that's another thing. If you do batteries, I mean, it's even the savings even, exponentiates between there. I mean, I did a quick estimate, if you pay $350 a month on electricity, just on average, I believe you could, after 20 years, you'd be saving 80-some thousand dollars,
I know.
So it's a big tax savings. But then also it's also a tax credit on the year that you put into service.
Exactly. And it's solar, it's renewable energy, right? So it's also
Absolutely.
good. Yep.
Absolutely. So it's, it doubles as a generator, like, a backup. If you get the battery backup, then, it doubles as a generator type of deal. So, there's pros and cons to that. But as far as tax savings, it's, straight 30%. So
Exactly. And I know you've always been telling us how you don't even pay money on your electricity bill. I'm just.
That's right. Been getting credits. So
not only saving money on tax, he doesn't even have to spend money. That's a double thing. Okay, good. Yeah, solar panels. For 2022, but what about 20? Is it the 30% go to 2023 as well? Too?
It is. It does as well. And I have not looked to see when it goes back down, but they made it back. They brought it back up to 30% for 2022 and 2023. So
good.
Yeah. So another couple other ones that we tax saving strategies for high income earners. These following ones I'm going to mention are kind of more for the business owners, right? People who have an LLC or or just kind of do a DBA or anything like that. Some of them pertain, and I'll make notes, and tell you which ones, where you have to have an LLC, things like that. But the first one that a lot of people always talk about is purchasing a vehicle, right? That is the tax deduction. One of the questions I get all the time is, do I have to pay cash for the entire vehicle, or can I finance it? And I say, no, you can finance it as long as it's used for a business purpose, and as long as it's more than 6,000 pounds. Then yeah, you can write off the cost of the vehicle, and then you can finance it. So if it's like a $75,000 vehicle, and you come in and you just put maybe $5,000 or $10,000 down, you got a $75,000 write-off in that year, and only cost you $5,000 or $10,000.
That's awesome. That's beautiful. Yeah. So you take the whole 100% depreciation on that.
Yeah, as long as it's 6,000 pounds or more, the vehicle is. So
that is correct. So apply for 2023 as well, right?
Yeah.
Okay. All right. Good. I thought it's only up to 2022, but okay, I was mistaken.
Yeah, there's limitations, with bonus depreciation, 2020 was the last year at 100% bonus depreciation. Okay. So 2023 is 80%.
Got it.
And then, and then it goes 20%, it reduces 20% every year.
Right. Yeah.
So, but then you also have
of something is better than nothing. Right?
Yeah. But then you also have Section 179 too, that you can still take, and the limit on that is, I think for 2023 now is like 1,160,000. Mm-hmm. So, if you have a business that, you put a lot of money into equipment, things like that, and you can write off up to 1,160,000, assuming you have the income to offset that.
Offset that as well.
Yeah, because for Section 179, you can't create a negative, income from Section 179. So that's kind of the difference between, Section 179 and bonus is, with bonus you can create a negative, whereas,
and carry forward as well, right?
Yeah, it does carry forward. Correct. Anything that's, let's say you use only 25 of the 75,000, the 50,000 that's left over gets carried forward for Section 179 purposes.
Good, good, good.
Yep. So another rule, or another, tax saving strategy that a lot of people don't know about is the Augusta rule.
Yeah.
So the Augusta rule is you have to be an LLC taxed as an S corp, C corp, or partnership. And the Augusta rule is like, let's say you are, you own your own business and you work out of your house. Sometimes you just have to work out of your house. Let's say, for example, we had some freeze days last, was it 21? It was not last year, but 2021, where, I know a lot of people couldn't work, but some people that did work, right, during those days, you work from your house, essentially, right? And so the Augusta rule is that you can rent out your house for 14 days or less per year, and you don't have to report that rental income on your personal return, but you get to take that rental expense on your business return. So that is a way, and the amount that you value, like depends on how you I'm also for the value of the amounts that you want to say, hey, I rented it out for X amount of days, how much is the value, the rental expense per day.
Correct. Need to be reasonable.
Depends on, yes, it needs to be reasonable, and you can't just say, well, it's $100,000 a day. Well, unless you live in $30,000 square foot house, maybe, but so yeah, the rental expense has to be reasonable, and there's rules on that, which can always get into more detail if you decided to do the Augusta rule.
Yes, I heard about that. So it has to be up to 14 days working from home, things like that. And that's great. I hope our listeners remember that, especially if you already, like many times, or you have to work from home because your home office is your home, and you're taking conference call, or just some day that like you mentioned the freeze or something happened. Also some of us may not even think about that. We already working from home, but we just never thought about the 14 days. So Henry, what if it's more than, maybe like 17 days? So the difference, what happened to that? Let's just say.
So if you do more than 14 days, you technically end up having to report that income on your personal return. So I would just keep it under 14 days, because that is the rule, and you don't want to say, well, I'm going to take 14 days and get the extra 3 extra days, and you have to report that income on your personal return as rental income. Then you have a tax liability on the personal side. So
good point there.
Yeah, but you mentioned home office, so that's the next topic that I want to discuss is home office is a deduction that some people do also overlook. So how that works is you get the square footage of your designated area in your house, whether it be 150 square feet, 200 square feet, whatever it is. It kind of has to be, the tax rule says it has to be the designated area for your business. Take that divided by the total square footage of your house, and then you add up all the expenses related to your house, whether it be mortgage interest, real estate tax paid, insurance paid on it, landscaping. We had a little freeze a couple months ago, or a couple of weeks ago, actually, that probably killed a lot of
the plants.
Landscaping. I know it killed mine.
Killed mine too.
Yeah. So those expenses, internet, electricity, gas, water, everything that you pay for your house, take all that and you multiply it by the
percentage.
By the percentage that you get from your business square foot versus total house square foot, and then you kind of get that as a tax deduction on your against your business.
That's good. I mean, yes, I can see a lot of people overlook. I mean, I know Donnie and myself, we always keep track of the majority of expenses because we are working from home, and we use that as a home office and taking a percentage, but never thought about landscaping.
I
was thinking only apply to inside, but landscaping is,
and repairs. I mean, repairs to your house too, right? I mean, if you had a pipe bust because of the freeze and you had to call a plumber there to repair, I mean, that everything is included. The form has it. The form has every line item that you can do, repairs and maintenance, insurance, even homeowners associations, you can deduct a portion of that. So through your home office.
Nice. Oh my goodness. So far we've been, I think, if whoever listening to this, I mean, you keep it in notes, you're probably saving over $1,000 already.
Oh yeah, definitely,
Right?
definitely.
Things that you don't know, right? Yeah, come on, bring it on,
Yeah.
Henry.
So another
Some
thing
more.
that's been pretty popular lately, and it's been around obviously forever, but putting your kids on payroll. If you have your own business, you want to put your kids on payroll. There's certain ways to do that to where you can maximize the benefit of that. So if the standard deduction, remember I kind of mentioned at the beginning, was $12,950. Well, that applies to every person, whether you're a kid or not, right? So if you are a kid and you work and you file your own taxes, even though your parents still claim you, you can file your own taxes and still get a $12,950 deduction. That's what the IRS is providing you. So if you pay your child $12,950, right, in W-2 income,
Right.
they when they file, they don't have to pay any taxes because they're going to get that wiped out to zero. And what happens is also is you have a $12,950 deduction on your business return.
Right.
So
it's a win-win, right? Because
absolutely.
they are living free
So,
rent.
yeah. So obviously the only thing you really have to pay is the Social Security and Medicare in it. So sorry. The only thing you really have to do is pay the Social Security and Medicare portion. But there is a way around that, and I'll discuss that in a little bit later as we kind of go further down my agenda here. So, but yeah, just keep that in mind. You do have to pay the Social Security and Medicare, and you have to match it too, right? So you have to do the withholding and the match of 15.3%, and you have to.
They're like your employees, basically.
Yeah.
That on the payroll.
Yeah. So there's a way around it, and I'll discuss it a little bit later.
But as long as the kid help you with something, even so, yes. Henry, what if the kids are like 2 years old? I'm just throwing it out there. What can we do? I mean, what can our listener do if they have a 2-year-old baby?
So you have to come up. You have to come up with a responsibility for the child, right? You can't say, "Oh, my 2-year-old child was a receptionist or they answer my phones," right? I mean, so I have a lot of optometrist clients. Yeah. And I said, well, they could do, they can be a model, right?
Right. Photography, right?
Yeah, for children. And you can do a model that you can put them in glasses and you can take pictures of them and put them up. And that was their, thing is to be a model for your business. And, but yeah, you can't just say, oh, my 6-month-old, worked for me. And, but you have to substantiate.
Reasonable. Yes, exactly.
You have to come up with a responsibility for the child, just like any other employee that you have. When you hire someone, you have to, make sure they understand what, their rules are and the role that they have. And same thing for your child. So.
Good. Yes. And so put a lot of their picture in your office, if you're an optometrist, a dentist, because that is imperfect, right? 2 years old, perfect teeth. So.
Yeah. And another thing for that, if you do pay them, you can actually, and now they have what they call earned income. Yes, they can put money away into a Roth IRA.
Exactly.
So then that grows tax-free for them.
I know. That's that's the win-win-win. That's three wins.
Yes, because think about it. If you have a, like you said, 2-year-old and you put away, 6,000, let's say roughly, whatever the Roth IRA limit is,
right?
Every year, and you just put that away every year, and it grows tax-free for your child. Exactly. I promise you, by the time your child gets to 21, they're gonna have a really nice Roth IRA portfolio. Because of the growth and everything like that. So, I mean, just doing the math. I mean, that's off the bat 126,000, right? That you put in, but then
it's a time value as well.
Yeah,
yes.
Growth wise over the next 20 years. I mean, I don't do the finance side of it, but I'm pretty sure you can probably get up to at least $500,000.
I'm sure.
Someone
imagine if you have $500, just invest in Amazon 10 years ago, you're probably a millionaire right now, right?
Exactly.
So might as well.
Exactly.
Yes. So put your kids on payroll. I believe, I just want to reiterate, Henry, the standard deduction for each individual. So a kid can be $12,900.
Yeah,
right?
both
But
of
make
us, I'm 950.
sure,
Yeah.
right? And make sure your kids have a reasonable responsibility, in your office in order to make sure that when you're doing something, always consider, is it reasonable? Does it pass the smell test from the IRS,
Yeah,
right?
right.
So
And you want to make sure that you're doing things, these are loopholes, but they're legal loopholes,
it's legal,
right?
exactly.
Yeah, I want to
I
call them
do
legal
it. I
loopholes.
put my kids in my business and
Yeah.
they help me.
So,
They're truly helping out as well.
I mean, even things like shredding paper, right? I mean, my business, I have paper all over the place sometimes. And even though it's paperless, I want to go, there's paper. I can say one of the responsibilities, hey, every week come in here, there's a thing and just shred paper, and that's that's one of your duties. So,
And it's also teaching them, okay, money doesn't grow from a tree. You got to work for it too. So
absolutely. Then it also teaches them the investment side with
exactly.
the Roth IRA. I mean, they won't get it now, but eventually one day they'll get it, and they'll be happy that you did it for them. So
Yes. Awesome. Hopefully, a listener, make sure you're putting that up.
yeah,
Just-
absolutely. So
yeah. Good,
yeah,
good.
so the
What
next,
else? What else, Henry?
so the
I
next
love
one is
this.
kind of up in your wheelhouse is
Yeah.
someone that makes $500,000 that had a lot of that has hopefully you didn't spend it all, right? Obviously you save some for uh, uh, federal income taxes, and also you have some money on the side. You could start putting money away to investment property, whether it be investment property, like actual the property that you purchase, or one of these the real estate syndications that you guys offer. They're all great opportunities, right? So one of the things to do is if you're a real estate investor, so I'm going to kind of jump back and forth real quick. So there's something called passive loss activity rules, right? As a real estate investor, it's normally passive income normally. If you have a job that you're making $500,000, what happens is you can't take the losses from the real estate and offset that, right? But there is passive loss activity rules where it says if you make less than 100,000, you can actually take a $25,000 loss from real estate activity, and it starts phasing out at 100, and at 150 it phases out completely. Right. And so that's assuming you're still a passive investor in these properties and investments, right? Mm-hmm. So and one of the ways to kind of get around that is if you qualify as a real estate professional, right? Then you can take any losses that you have from the real estate investments that you guys have, or investment property, and you can't take it against your W-2 income, right? So in order to do that, in order to qualify as a real estate professional, you have to have mainly two things. You either have to have 750 hours in real estate property to trade, right? Or half of the time of your working, throughout the year is time materially participating in real estate property.
Correct.
So yeah, those are the two main things. And if you have a spouse that works a little bit, or stays at home, takes care of the kids, or just takes care of the house, then that'll be a perfect opportunity to make them into a real estate professional, and then the real estate professional, them qualifying as a real estate professional can then offset your W-2 income whenever you file married filing joint.
Yeah. So talk about that. We do have a webinar that talk about how to qualify for a real estate professional. So if you're interested or curious about how to qualify, we actually have a lot more detail on how to qualify it, and what are the criteria. We will put on a link in the comments, or we'll send it out. Just let us know. And then, yes, you can take a look at that as well. Thanks, Henry, for pointing that out. Yes.
Yeah. So real estate, another thing I wanted to mention about real estate in general, and this one is it's one of the few investments that you can actually show a loss on paper through depreciation, right? But actually have positive cash flow.
Exactly.
So yeah, and so talking about that is we're going to get into, well, how does that work, right? How do you have on paper, a loss, but then actually positive cash flow? Well, one of the main things is depreciation. That is the main thing, right? So if you bought a let's say you bought a $2 million piece of property, right? And you can say where you bought it yourself, or let's say you did it through,
Syndication was,
a syndication that one of you guys offer, right? So
Right.
you buy a $2 million piece of property. First of all, you have to split it between the value of the land and the value of the building. That's the first split you have to do, right? So you have to decide what the value of the land was, what the value of the property was. I mean, the value of that building. So let's assume in this example that $1 million is the land, $1 million is the building.
The building, yep.
So with the land is not depreciable. Land is land. Whatever the value you put as land, it's going to stay. You can't depreciate it. It just stays with the investment. And when you sell it, that's your basis. The $1 million that you apply toward the building, well, if it's a residential, it's depreciated over 27.5 years. Or if it's commercial, then it's 39 years, straight line for both of them. Okay. Well, there's no advancement. There's no advance in taking depreciation on that, because it's mainly just 27.5 years or 39 years. But there's this thing you can do is called cost segregation study.
Exactly.
So what that does is when you buy the building, right, you say, well, the building, under tax law is 27.5 years for the apartment complex, right? Well, that's just mainly for the frame of the building, right? So if you do a cost segregation study, what they do is they separate everything from doors to knobs to appliances, like refrigerators and stoves, and all the way up to paints and everything. They take all that into account, roofing and everything. They separate everything. They put it in different buckets. And then once they put it in a certain bucket, you can take, depreciation on this at a shorter period of time versus the 27.5 years for apartment complex. And that's where, advanced depreciation comes in, and you can start, taking a lot of losses in the first couple of years of acquiring a real estate investment, but you still have positive cash flow.
Exactly.
So that's how that works. So I have a lot of clients who ask me about how it works, and it's that's kind of the a quick summary of how that how you get positive cash flow but actually show a loss on your tax return.
And that's just exactly why we do, for what we do in DROX Investment Group is our apartment syndication. So you buy into a big apartment, let's just say $20 million. So when we do cost segregation, we actually pass it back 100%, all of them, to our investor based on the percentage that you invest. And 2022 was the last year for 100%, like what Henry was mentioned, 100% for bonus depreciation that you can just, because of time value, we want to take it everything the first year. But for 2023, it's not like it's gone away. It's 80% now.
Right.
So from that, but like I say, 80% rather than nothing. And that loss, based on your status on your IRS, right? Yeah. Either you qualify for the real estate professional. If not, then you can even offset that with, either your other passive income, or if you cannot even use it for that particular year, let's just say 2023, you cannot use it, you can also carry it forward as well. So it will, you're not going to lose your money. And then let's just say you're a W-2 earner, high income earners, but you have no others. You're not qualified for real estate professional. You have no other passive income. You just continue carrying that, offset that with any capital gain from the investment. And then even when you're selling that investment, let's just say 5 years from now, you can even still offset that from the depreciation. So that is just to say, 90% of the millionaires or come from the real estate is because of that tax defer. And imagine every money, let's just say $100,000. If you today versus $100,000 in 5 years from now, today is much more due to the inflation. The value of it is much more important than 5 years from now. So, and you can just continue to kick the can down the road, things like that. But yeah. Thanks for that, Henry. Yeah, that is a very high, I would say, strategy. But of course,
it's a tax strategy, absolutely.
But you gotta own a property or invest in order to take
Yeah,
advantage
absolutely.
of that.
And then one more thing is you do all these and you get, you do all this to get advanced, like to get the depreciation high in the beginning. So what that does is that lowers your basis, right? So you kind of said, well, in 5 years, let's say you sell it.
Yep.
So you're like, oh my gosh, I bought this property for $2 million. I wrote off, 800,000 already, or so. Let's just call it, 700,000. Let's say I wrote 700,000 over the next 5 years. My basis is 1.3, right? I bought it for 2 million, but my basis is 1.3. Now I can sell it for, let's say, $4 million. And you're like, oh my gosh, now I'm going to have a, $2.7 million gains. Well, guess what? Another strategy is Section 1031 exchange.
1031 exchange. Yep.
Right. And so that you do that, you can defer the gain and you put it into another property and it just keeps on going and going. So these are strategies, like you're saying, and you have to understand how these strategies work in order to implement them. And that's why, working with the CPA, is very important. Is, you don't want to just talk about what happened last year. For me, I don't talk about what happened last year. I do, but then I say, hey, what's your plan for the next couple of years? Do you want to sell this property? You want to, what? And some people are like, no, I'm gonna keep it for forever. I'm gonna, pass it down to my kids. Okay, well, there's also a strategy for that as well. And then some are like, no, I'm gonna wait for it to, I'm gonna fill it up and then I'm gonna, get good cash flow out of it. I'm gonna flip it and make, 300,000-400,000. Well, and I tell them, like, so you want to pay taxes on that in the next, at that time? They're like, no, how do I not? And then that's when we, implement these other tax strategies and make them aware of it. Because some things is timing based. A 1031 exchange is based, there's a time, and you have to have the right people in place in order to make it work according to the IRS rules.
It's about, very important is tax planning.
Yeah.
Like, very, very important. So talk to your CPA about tax planning. Even don't, think long-term as well, because in order to save money, if you reactive, it's actually much harder to do than proactively. And that's why we want to talk about this type of tax strategy in the beginning of the year, because now we want you to start thinking about it and talk to your own tax advisors and CPA to say, how can you save money, put more money in your, rather than talk to your tax advisors on December. Right.
Mm-hmm.
So
yeah, absolutely.
That's a little bit too late. Right?
Sometimes it is too late. Sometimes it is too late at that point in time, or sometimes the transaction has already occurred. And so you can't really make any changes after the transactions already occurred. You can't say, well, I can't do a 1031 now. No, it's, you have 180 days to purchase another building after you sold it, the old one. And that doesn't, if that wasn't the case, it doesn't work out. And you have to have a 1031 agent involved. So it's very important to keep your CPA or tax preparer in the loop, so that they know what's going on. And I always ask my clients, hey, if anything, just give me an email or give me a call and, we can talk about it, because, a 5-minute phone call can save them thousands and thousands of dollars.
Yes, exactly. Good. Thanks for that tips, Henry.
Yeah. So the last main thing I want to talk about, which, have very limited of these, because you have to make a lot of money in order to really, truly benefit from this, is if you own your own business and, let's an LLC taxes an S Corp, let's say, and you're making probably, $1 to $2 to $3 million and up from this, business. Let's say you're a doctor, right? And you make $3 million a year net. Well, what you could do is, the main thing you want to do is, and I'm going to be very brief and, kind of give you an overview, is you want to create a management company, right? So as a doctor, you own the S Corp 100%, right? And the business is, a family practice. So you're the doctor, you are acting as a doctor in the medical practice. So you get a W-2 from that, and that's fine. You're supposed to, right? But what about the operations of the company? When I'm talking about operations, I'm talking about, hiring, making sure tax returns are filed, legal and professional, guidance, IT, paying the bills. Who does all that for you? Well, you might have some people paying the bills for you, but most of the time you're doing the hiring, you're getting with your CPA, making sure tax returns are filed, IT stuff. most likely you're contacting your IT guy and saying, or telling your office manager to, contact IT, but you're still involved in the operations side of it, right?
Yes.
So as a business owner, you're not just performing your duty as a doctor, you're also performing the operations to run the business. So what we do is we create a management company to manage the operations side, right? So your S Corp LLC pays the management company. So there's three different ways, or the three different management companies that you can set up. But in this case, we're going to talk about just creating a management company. You can pay the management company $300,000. Let's say it's just a magic number I'm going to use. And then the management company itself will have its own deductions, right? You can do a home office deduction, right? With the management company, because all those tasks that you're doing, some of those tasks that you're doing is probably from your house, right? And so, you can have your family on payroll,
Right.
okay? And this is one of the things I was telling you about earlier is there's a little legal loophole. The management company, if you set it up as a single member LLC versus another S Corp or something like that, if you do a single member LLC and you pay your kids from a single member LLC, you do not have to withhold payroll taxes.
Oh.
Very big, legal loophole.
But it has to be a single member LLC.
Yeah, it's called a single member LLC where you own it 100%. So, so with family on payroll, right? You can travel with them and expense it, right? I'm not saying you can go to Disney World and expense everything, but if you were in the business of, let's say, real estate, and you travel with your family, okay, and your kids are with you, your spouse is with you, and you go, again, I'm gonna say, let's go to Florida, and you want to look at some
conference or like looking at properties.
Yeah. Right? You can go to Vegas for a conference. Well, there's limitations on what you can expense, but there's more substantiation to say, hey, look, my kids are on my payroll, my wife's on my payroll, and I'm going to Vegas. There's a real estate conference. We all went, even my kids went, right? Yes. And there's more substantiation to take those expenses versus, oh, I'm the only one going to this real estate thing. My kids are just here. Well, there's a lot of limitations. You have to carve out how many days you're at the conference, how much was your plane ticket only, how much was your hotel portion only, things like that. So having them on payroll, it's always.
That just makes sense. Yeah. Wow, that's very powerful.
Yeah, so you want to do things where you can enjoy with your family and set it up to where it's also a great way to
reduce taxes.
Expenses.
Expenses.
Reduce your taxes.
Wow.
So so those are one of the the management company. Like I said, I won't get into into too detail, but that's something to think about. Well, I'll talk about one more, which is you can have a rental management company. So if you have your own LLC and you manage your properties, well, you can create a management company to manage your properties, and you can write off things inside there, and have the same thing. You can have your kids help you, and you have a home office deduction. You could write off your cell phone to manage the properties. And so management companies is something to think about, but a lot of people don't, because you have to be really high income earner to kind of venture down that path. Yeah, it's just a lot more filing requirements and a lot more direction and guidance that I give my clients and say, okay, you have to do this under the management company, you have to do this under your S Corp LLC. You can't mix it. And so if you follow the rules and you follow the path that we provide, it's going to work. So
good. Hey, thank you so much, Henry, for all these golden nuggets, because it's just so powerful. There are many things I didn't even know. So now Donnie and I will actually need to go back and take a look at our 2023's tax strategy as well. And I hope whoever's been listening to this, you guys can take, this is very, valuable, because you're going to sit down with Henry or any of your CPA. This is $100,000 or thousands of dollars per hour to get all these tips. And so we want to thank you again, Henry, for your time. And secondly, Henry, if the listeners want to contact you, how can they contact you? And I'm going to put whatever you put in on the screen or in the comments. Yeah.
Sure. Yeah. My email is Henry, HENRY at hdn-cpa.com. And office number is 832-429-7652.
Awesome. I know you in Houston, and I know you told me this because of our friendship. You say if any of our listeners also, if you want to have a quick chat with consulting with Henry, he probably will give you first 15 minutes free consulting. So
yeah, absolutely.
And I'm just gonna let you guys know this. Henry would tell you the way it is. Okay, he would tell you if he's gonna help you or you are good at your place. Because that's one of the things we Donnie and myself know Henry for like more than 18 years ago. We went to St. Thomas, University of St. Thomas together. And so very well trusted. He will say, he will tell you the way it is. And that's just something that I really, truly appreciate from a CPA, because that's what you want in a CPA. And from, he knows the rules from the IRS, very knowledgeable about that. And when you're doing, the tax code is too complicated for us regular people. This is not our day-to-day jobs, right? We want to go work. We all have different profession, but this is what Henry's profession. He's been doing this for the last 18 years. So again, thank you, Henry, for your time. And and one more thing, I know last time Henry did a webinar with us on the K1, the full cycle of the K1. So when he mentioned again with the tax and the bonus depreciation, how it's actually look like in the full cycle when you do investment, also check on the link below. Henry was there to provide us that explanation. What does that look like as well? Again, Thank you so much. And you have a nice day, Henry.
You're welcome. Thank you for having me.